Well, growth stocks continue to be stock market leaders, driving indexes like the S&P 500 and the NASDAQ 100 to all-time highs. But which growth ETF is the optimal way for investors to get exposure to this exciting area of the stock market? Well, today's ETF battle features an audience-requested triple header between growth index ETFs from Charles Schwab, State Street Global, and Vanguard. Who wins the battle? Find out right after this. It's great to see you again. I'm Ron DeLegge, and welcome to ETF Battles. This is where we congregate to analyze your ETF matchups with the purpose of helping you make informed investment decisions. If there's an ETF battle you'd like to see, hit me up in the comment section below with your ETF ticker symbols, or you can find me on X. Just find us at ETF Guide. Again, that's on X. And again, be sure to give us your exact ETF ticker symbols. Don't ask me which ETF ticker symbols you should be giving me. That's your homework assignment. So also, I just want to remind you, be sure to visit the description section below this video. I've got links to our program judges, along with links to our program sponsor direction. Lots of good resources down there, so don't miss it. We've also got free audio as well as ebooks and other goodies. Now, today's ETF contest is a triple header. It was requested by a viewer named Dr. Snow. Yes, please don't remind me because it's too early for snow, Doctor. It's still autumn, and I haven't even eaten my first slice of pumpkin pie. Thank you, Dr. Snow, for your ETF battle suggestion, and it looks like a good one. We've got another heavyweight bout, this time between Schwab, Vanguard, and State Street Global. So who wins the battle? Well, let's find out what our judges have to say about this. Dave Kreinces with ETF PM and David Dierking with TheStreet.com. Judges, thank you for being here.
Hey, Ron, good to be back again.
Ronnie D. Hey, Dave. Let's battle.
Cost, exposure, strategy, performance, and mystery are the four battle categories. The mystery category is where our judges can choose any factor or thing that they feel is important to today's contest. Our judges can nominate wildcard ETFs if they feel there's better choices somewhere else, or they can opt for split decisions. I'll be keeping score, and at the end of the program, we will reveal the scorecard and declare an overall winner. And keep in mind, none of the battle outcomes are ever predetermined or known in advance by myself or our judges. The first category is cost. David Dierking, please get us started.
Yeah, it's not often that you come across a battle like this where Vanguard is actually the highest cost fund in the category, but this is one of them. VOOG comes in at 10 basis points. SPYG and SCHG are both at 4 basis points, so a fairly sizable difference there. If you want to go the really low-cost route with Vanguard, the Vanguard Growth ETF, VOOG, also comes in at 4 basis points. Has a similarly large cap growth tilted strategy if you really want to even it out on cost. But within the three ETFs we're talking about here, I'll give it a split between the Schwab and the State Street ETFs.
Dave Kreinces, you're up next. How do you see it when it comes to cost?
Well, Ron, I agree with my fellow Dave. These three passive funds are all super cheap index ETFs, and we strongly favor total return and risk metrics over cost. And since these ETFs cost 10 basis points or less, I call this category a split decision.
Next up is exposure strategy. So Dave Kreinces, give us your analysis.
For exposure, we have three U.S. large cap equity growth funds from Schwab, State Street, and Vanguard, all with roughly 230 holdings, and their positions are close. However, the NASDAQ 100 is still our favorite for core equity exposure because we favor that beautiful index methodology. So I give the exposure win to wildcard ETF QQQM, and in its absence here, I call the exposure category a split decision.
David Dierking, you're up next. As far as exposure strategy, how do you see it?
Yeah, in this one, the three ETF battle really becomes a two ETF battle because SPYG and VOOG both track the S&P 500 growth index, so they're essentially identical to each other. The only difference between those two and the Schwab growth ETF is that it starts from a starting point of the top 750 stocks instead of the S&P 500. So it has a little bit of a broader universe to choose from. You're getting a little bit more mid-cap exposure in there. But like my fellow Dave said, you really have to kind of grab your microscope to really see some of the differences in this fund, or in these funds rather. They all have about 50% tech exposure, which you'd kind of expect to see. The only real difference is the Schwab ETF has a 10% allocation to healthcare versus about 6% for the others. So again, that's not going to be a needle mover, but when you have three large cap growth strategies, you really have to kind of split hairs to find differences. But in this category, the exposure is essentially identical. They're very highly correlated. So I'm going to call this one a split decision across all three ETFs as well.
Up next is performance. And Dave Dierking, you're still up. Give us your analysis. How do you see these ETFs in terms of their performance versus each other?
Yeah, you think in this category that the performance would be very similar. And again, between SPYG and VOOG, the performance is essentially identical since they're the same fund pretty much. The Schwab Growth ETF actually has a fairly significant performance advantage. If you look over the past 5 years, it's outperformed the other two by about 3% annually. And over the past 10 years, it's outperformed by about 1.5% annually. So that's not an insignificant difference for a group of funds that really look pretty similar on the surface. So I'm going to give the performance win here clearly to the Schwab Growth Fund. It's clearly done better than the other two over the past several years.
Dave Kreinces, you're up next as far as performance. How do you see it?
Ron, on performance this past decade, the Schwab Fund looks impressive, but it was no match for wildcard NASDAQ 100. This data shows that QQQ returned almost 4.5 times your money, which was well ahead of the Schwab Fund. So I give the performance win to wildcard QQQ for active traders and the lower cost version QQQM for passive buy and hold investors. We also show that technology 3 times Teckle, semiconductor 3 times Soxel, and NASDAQ 100 3 times TQQQ all strongly outperformed over the 10-year period. The 3 times technology TECL delivered more than 31 times your money. And while the top leveraged ETFs and cryptocurrencies have been strong long-term trends, these assets crash hard at times, and we do raise cash quickly as needed. So I give this large cap growth performance win to QQQ, QQQM, and TQQQ. And in their absence here, I agree with my fellow Dave and give the performance win to SCHG.
The mystery battle category is next. This is where our judges can give us that key factor that they think is important, or maybe multiple factors. So Dave Kreinces, what is your mystery battle category and which of these ETFs wins it?
You know, my mystery category is always position size, and large cap growth allocations are often the largest weighting for growth investors. And since these battle ETFs and QQQ are all somewhat diversified, we could allocate up to 100% exposure to any of these funds in our active strategies. So I call the position size category a split decision.
David Dierking, how do you see it with terms of your mystery battle category? What is it and which of these ETFs wins it?
Yeah, my mystery category is going to be share splits, which is, it sounds a little counterintuitive when it comes to ETFs, but I bring this up because just recently in October, the Schwab ETF executed a 4-for-1 share split, along with a number of other of its ETFs. And basically, a share split is nothing more than just an accounting adjustment. You just, quadruple the number of shares, you cut the share price into a quarter of what it was before, and it's essentially the same thing. With stocks, of course, people view that as a sign of management confidence or a momentum builder. So a lot of traders will start buying shares when they hear there's a share split. With ETFs, share splits are really non-events because these funds have baskets of hundreds of securities, and there's no way that these stocks are all going to rally on a share split of a corresponding ETF. So I just bring this up because it's a possibility with ETFs, just like it is for stocks. Vanguard has done a couple of share splits and its ETFs in the past, not many, but VOOG is trading at around $350 a share right now, so I suppose it's not out of the question. We could see that ETF split as well, but for the purposes of this battle, I'll just call it a split decision across the board because this affects all the ETFs equally, but just something to be educated about.
Yeah, and also makes those share prices a little bit more affordable for investors that may have smaller accounts looking for round, even lots, correct?
Yeah, absolutely. Yeah, makes it cheaper to buy if you just want to buy one share. Takes a lot less money, makes it easier for the small guys to get in.
All right, very good. So now we move to the part of the program where our judges can give us their overall battle winner. How will this go down? David Dierking, you're up.
Yeah, I'm going to give the win to the Schwab Growth ETF, and I think it's just really a combination of all the factors we've talked about. It's the cheapest of the bunch. It has the best historical track record in terms of performance. I like how it targets a bigger starting universe, so you get a little bit broader exposure in there. You bring some of the mid caps in, so I think that probably has helped performance over time as well. And again, on the share split topic, like we talked about, investors can get access to shares for just a fraction of what they were before. So it's easier to buy. It'll become more liquid, which is a great thing. So hats off to all three of these ETFs. I think they're solid investments, but the Schwab ETF gets the win for me.
Dave Kreinces, your final chance to weigh in with your overall winner.
Well, Ron, to recap this U.S. large cap growth update, we believe the NASDAQ 100 is the next generation S&P, and TQQQ is the American Dream ETF. And TQQQ will not win every single decade. However, over 14.7 years since its inception, this GOAT diversified equity fund now has a total return of 189 times your money. Let that sink in. So, surprise, surprise, I give this aggressive growth battle win to wildcards QQQ, QQQM, and TQQQ. And in their absence here, I give the win to SCHG.
Right, but it's okay. You can nominate those over SCHG if you want, so it doesn't have to be in your absence. So do you feel more strongly about those three tickers over SCHG?
I'm sorry, the viewers can know that I do favor SCHG over the other battle tickers, but the security that we're investing in is the NASDAQ 100.
Okay, got it. Well, our judges have spoken, and according to my final battle scorecard, this is a split decision between SCHG, and then we've got a mess of wild cards from Dave Kreinces to triple Qs, and then triple QM, and then, of course, the leverage version, 3X on the triple Qs, TQQQ. And I think our judges made some strong points. David Dierking mentioning that SCHG picks from a larger universe of stocks. I believe that was 750 versus just focusing on S&P 500 growth stocks. So that was a key differentiator. It also leans a little bit more towards those mid-cap stocks and with some of its holdings. It also has lower expenses as well as better historical performance. So SCHG was his choice. And then Dave Kreinces also agreeing in some of those categories on SCHG, but also mentioning that his favorite is really that heavy tech exposure and the growth stocks in triple Qs, as well as all of those ticker symbols mentioned in his wildcard choice. And those were some amazing numbers tossed out at us. Of course, we remind the audience that historical performance is not predictive of future results, so just keep that in mind. And then, of course, with growth stocks, you're going to have much higher volatility compared to other types of stocks. For example, dividend stocks or maybe value stocks. So just keep that in mind. But I think, again, this is an interesting area for long-term investors to take a look at, and certainly a very good place if you're looking to grow capital. Thanks again to Dave Dierking as well as Dave Kreinces for your excellent job at breaking down today's triple header. We couldn't have done it without you.
Thank you, Ron. Thanks, Dave. Own the Matrix, people.
Thanks, guys. Good to see you.
Well, be sure to visit the description section below. We've got links to our program sponsor direction, along with links to our program judges. So don't be a stranger. Also, while you're down there, be sure to hit the comment section below. Let us know how you enjoyed today's battle. And let us know, too, if there's a specific ETF matchup that you'd like to see. If there's another viewer that's posted a matchup that you think makes sense, just hit the like button on that battle suggestion. And then one final note, be sure to check out our Season 5 playlist just to make sure that any of the battle suggestions you're making to us are matchups that we have not already done. Well, I'm Ron DeLegge. Thanks for watching ETF Battles, and we'll see you on the next episode.